What if the financial stability you've worked your entire life for was built on a foundation of sand? A foundation saturated with trillions of dollars in debt, ready to be washed away by the next economic tide. It's not a question of if, but when. In 2008, we saw a glimpse of what happens when the system cracks. But what's coming is different. It's bigger, more complex, and it involves not just Wall Street, but the government, major corporations, and even your own household. This isn't fear-mongering. This is a wake-up call. Because a silent, ticking debt bomb is set to explode. And when it does, it will redefine wealth and poverty for a generation. Stay with me, because your financial future depends on understanding what's happening right now. Welcome to Hope to Wealth, the channel where we explore the real emotional stories behind money to help you build a secure future. Today, we're tackling a topic that financial insiders are whispering about in hushed tones: the global debt superbubble. It's a story of greed, miscalculation, and decades of kicking the can down the road. We're going to unravel the three core threads of this crisis: the staggering national debt that's becoming unpayable, the mountain of corporate debt hiding zombie companies, and the personal debt that has millions of families living on the edge. This isn't just about numbers on a screen. It's about your mortgage, your 401k, your job security, and your ability to provide for your family. By the end of this video, you will not only understand the immense risk we all face, but you'll also have a clear, actionable plan to build a financial fortress around your assets. This is one of the most important videos we've ever made, so if you are ready to face the truth and take control of your destiny, do me a favor and hit that like button and subscribe to the channel. You won't want to miss this. The anatomy of the bomb, more than just government spending. To truly grasp the danger, we need to understand that this isn't a single bomb. It's a cluster bomb. 3 explosive charges wired to the same detonator. First, let's talk about the one we hear about most: national debt. In the United States, we're talking about a figure so large it becomes almost meaningless. Over $34 trillion. But here's what makes it real. The interest on that debt is now one of the largest expenses in the federal budget, set to surpass defense spending. Think about that. We're spending more just to service our past borrowing than to protect the nation. Every dollar spent on interest is a dollar not spent on infrastructure, healthcare, or innovation. It's a silent tax on future growth, a ball and chain on our economy. But how did it get so big? It's a bipartisan story of decades of deficit spending, unfunded liabilities for programs like Social Security and Medicare, massive stimulus packages, and tax cuts that weren't offset by spending cuts. It's the political equivalent of putting everything on a credit card with no intention of paying off the principal. This massive government borrowing has soaked up capital that could have gone to the private sector, and it's propped up by the Federal Reserve's ability to print money. A solution that leads directly to the inflation that eats away at your savings. The second charge is corporate debt. After the 2008 crisis, central banks dropped interest rates to near zero. It was like a free money party for big corporations. They borrowed record amounts, but not always to invest in new factories or research. A huge portion of it went into stock buybacks. This artificially inflates their stock price, making executives look good and triggering their bonuses. But it leaves the company hollowed out, with a fragile balance sheet. We now have a legion of what are called zombie companies. Businesses that don't earn enough profit to even cover their interest payments. They only survive by taking on new, cheaper debt. But now that interest rates are rising, their life support is being switched off. One by one, they will start to fail, triggering layoffs and a domino effect across their supply chains. The third, and perhaps most personal charge, is household debt. We're at record levels of credit card debt, auto loan debt, and student loan debt. For years, Easy Credit has papered over the fact that wages haven't kept up with the cost of living. Families used debt to maintain their lifestyle, to buy a car to get to work, to put their kids through college. Buy now, pay later schemes have exploded, encouraging instant gratification while hiding the long-term consequences. This makes the average family incredibly vulnerable. When a recession hits and layoffs begin, millions won't be able to make their payments, leading to defaults, repossessions, and personal bankruptcies. These three debt bombs, government, corporate, and household, are all interconnected. They feed off each other in a dangerous cycle, and they're all sensitive to the same trigger: rising interest rates and a slowing economy. The ghost of 2008, why we learned the wrong lessons. To understand our current predicament, we have to look back at the last great financial earthquake, 2008. It's a powerful emotional story because it wasn't just about banks. It was about people losing their homes, their life savings, their hope. The story then was about subprime mortgages, toxic debt packaged and sold as safe investments. When the housing market turned, the whole house of cards came crashing down. The lesson we were supposed to learn was about the dangers of excessive debt, reckless lending, and a lack of transparency. But did we? The response from the world's governments and central banks was to fight a debt crisis with more debt. They slashed interest rates to zero and unleashed a policy called quantitative easing, or QE. Essentially, they printed trillions of dollars out of thin air to buy government bonds and mortgage-backed securities. The goal was to flood the system with cheap money, to encourage borrowing and spending, and to prevent a full-blown depression. In the short term, it worked. The stock market bottomed out and began a historic, decade-long bull run. But this solution was a Faustian bargain. It didn't solve the underlying problem. It just transferred the debt from the private sector to the public sector and created a series of new, even larger bubbles. The era of free money fundamentally warped our economy. It punished savers, who earned virtually nothing on their money in the bank. It rewarded speculators and risk-takers. It allowed those zombie companies we talked about to stay alive, preventing the natural, healthy process of creative destruction where weak companies fail and their resources are reallocated to stronger, more innovative ones. This led to a misallocation of capital on a scale never seen before. Money flowed into speculative assets like tech stocks with no profits, cryptocurrencies, and NFTs, instead of into productive capacity that creates long-term value in good-paying jobs. It also dramatically increased wealth inequality. The wealthy, who own most of the stocks and real estate, saw their net worth explode. Meanwhile, the average person saw the cost of living, housing, education, healthcare skyrocket, fueled by this ocean of cheap money. They were forced to take on more debt just to keep up. So, the ghost of 2008 isn't just a memory. It's the architect of our current crisis. The very tools used to save us then are what created the everything bubble we're in today. We didn't deleverage. We just shifted the leverage. We didn't learn the lesson about debt. We became even more addicted to it. And now, as the central banks are forced to raise interest rates to fight the inflation they created, the whole fragile system is beginning to shudder. The tide of free money is going out, and we're about to see who's been swimming naked. If you're finding this breakdown helpful in understanding the big picture, please take a moment to hit the like button and subscribe. We need to get this message out to as many people as possible. The corporate crack, when buybacks become busts. Let's zoom in on the corporate debt bomb, because it's the one that could directly impact your job and your investment portfolio. Imagine you're the CEO of a publicly traded company. Your compensation is tied to the company's stock price. For the last decade, you've had a magic button you could press to make the stock go up. That button was cheap debt. With interest rates near zero, you could borrow billions of dollars. You could use that money to invest in new products, expand operations, and hire more people. Or, you could use it to buy back your own company's stock. When a company buys its own shares, it reduces the number of shares outstanding. This automatically increases the earnings per share, EPS, a key metric that Wall Street loves. A higher EPS often leads to a higher stock price, and a higher stock price means a bigger bonus for you. It's a simple, legal, and incredibly tempting shortcut. And for 10 years, corporate America went on a buyback binge of epic proportions, fueled entirely by debt. Companies like Apple, Microsoft, and Google have spent hundreds of billions on buybacks. But it's not just big tech. Companies across all sectors have prioritized financial engineering over real-world innovation. The problem is, this creates a facade of health. The company looks great on paper. Rising stock price, happy shareholders. But underneath, its foundations are rotting. It's carrying more debt, making it more vulnerable to a recession. It has less cash on hand for emergencies, and it has underinvested in its own future. Now, the party is over. Interest rates have risen dramatically. That cheap debt needs to be refinanced at much higher rates. Remember those zombie companies we discussed? They are the canaries in the coal mine. As their debt costs soar, they will face a grim choice: drastic cost-cutting, layoffs, or bankruptcy. But it's not just the zombies. Even once healthy companies are now feeling the squeeze. They are so loaded with debt that a mild recession could become a fight for survival. We could see a wave of corporate defaults far exceeding what we saw in 2008. What does this mean for you? First, if you're an investor, it means many stocks in your portfolio might be far riskier than you think. Their shiny performance over the last decade was fueled by leverage, not fundamental strength. Second, it means increased job insecurity. When companies need to cut costs to service their debt, the first thing to go is usually payroll. We are already seeing this happen in the tech sector, but it's poised to spread. The corporate debt bubble is a direct threat to the two main pillars of most people's financial lives: their investments and their income. It's a slow-motion train wreck, and the sound of screeching metal is getting louder every day. The kitchen table crisis: drowning in good debt. Now, let's bring this story home to the kitchen table. Because the most insidious part of this debt bomb is how it has woven itself into the fabric of everyday life. We've been sold a narrative that some debt is good debt. A mortgage is good debt because you're building equity in an asset. A student loan is good debt because it's an investment in your future earning potential. An auto loan is necessary to get to work. But what happens when the price of those assets is inflated by a bubble, and the promise of future earnings doesn't materialize? Let's start with housing. The zero interest rate policy after 2008 drove a housing frenzy. People could afford a much larger mortgage when the interest rate was 3% than they can now at 7%. This drove prices to unsustainable levels. Now, millions of families are house poor, with the majority of their income going to a mortgage on a property whose value is likely to fall in a recession. They are trapped. They can't sell without taking a loss. And they can't afford to move. Their single biggest asset has become their single biggest liability. Then there's student debt. We've told a generation that a college degree is the golden ticket. But tuition costs have outpaced inflation by a staggering amount. This has created a $1.7 trillion mountain of debt, shackling young people just as they are trying to start their lives. Many are graduating with mortgage-sized debt, but without the high-paying job to go with it. This delays their ability to buy a home, save for retirement, or even start a family. It's a massive drag on the entire economy. And what about auto loans? The average price of a new car has soared, and to make them affordable, lenders have stretched out loan terms to 72, 84, or even 96 months. People are now taking out 8-year loans for a depreciating asset. By the time they pay it off, the car is worth a fraction of what they paid. Many are underwater on their loans, meaning they owe more than the car is worth from the moment they drive it off the lot. Finally, there's the high interest rate killer, credit card debt. It has surpassed $1 trillion for the first time ever. For millions, credit cards are no longer for convenience. They are a survival tool used to pay for groceries, gas, and utilities as inflation erodes their paychecks. With interest rates on these cards averaging over 20%, it's a debt trap that is nearly impossible to escape. When you add it all up, mortgages, student loans, auto loans, credit cards, the American household is more fragile than it has been in decades. A single unexpected event, a job loss, a medical emergency, is enough to push millions over the edge into a spiral of default and bankruptcy. This is the personal, emotional heart of the debt crisis. And this is why it's so important that we talk about it. If this is resonating with you, and you want to learn how to get out of this trap, please support the channel by hitting subscribe and clicking the like button. Your engagement helps us help more people. The sovereign debt spiral, when the printer runs hot. Now we have to zoom back out and look at the biggest player of all, the government. Because the government's debt is the ultimate backstop for the entire system, and it is flashing red alert. As we said before, the U.S. national debt is over $34 trillion. To put that in perspective, it's more than the economies of China, Japan, Germany, and the UK combined. Every year, the government spends more than it takes in through taxes. This is called a deficit. To cover that deficit, the U.S. Treasury has to borrow money by selling bonds. For decades, this was a smooth process. There were always buyers for U.S. debt, because it was considered the safest asset in the world. Countries around the world, like China and Japan, bought trillions of dollars of our bonds as a way to store their own national savings. But something has changed. The sheer volume of debt we need to issue is becoming overwhelming. And with rising inflation and interest rates, our existing bondholders are getting nervous. Why would China want to hold a U.S. bond paying 2% interest when their own inflation is higher and the value of the dollar is uncertain? As a result, we are seeing foreign demand for our debt begin to dry up. So, who is buying all this new debt? Increasingly, the buyer of last resort is the Federal Reserve itself. This is a process often called debt monetization, or more simply, printing money. The Treasury issues debt, and the Fed creates new dollars on its computer to buy that debt. This is the ultimate free lunch. Except, it's not free. The cost is the debasement of the currency. The more new dollars are created, the less each existing dollar is worth. This is the true cause of the persistent inflation we've all been feeling. It's not just supply chain issues or corporate greed. It's a deliberate policy of devaluing the currency to make the national debt more manageable. We are caught in a sovereign debt spiral. We have to borrow to pay for our spending. To entice buyers for that borrowing, we have to offer higher interest rates. But those higher interest rates increase the deficit, forcing us to borrow even more. It's a feedback loop from hell. There are no easy ways out. We can't just grow our way out of a debt this large. Cutting spending is politically impossible for most politicians who want to get re-elected. And raising taxes enough to cover the gap would crush the economy. So, the most likely path chosen, as it has been throughout history for indebted empires, is the path of inflation. They will continue to print the money, silently stealing the purchasing power from your savings and your paycheck. Your cash in the bank is a melting ice cube. Understanding this is absolutely crucial. The very nature of money is being changed, and those who don't adapt will be the ones left paying the price. The detonators, 4 horsemen of the debt apocalypse. So, we have this massive, unstable pile of government, corporate, and household debt. It's a powder keg waiting for a spark. What could be the detonator that sets it all off? I see 4 primary candidates, the 4 horsemen of our potential debt apocalypse. The first horseman is a policy mistake. Central banks are walking a tightrope. They need to keep interest rates high enough to fight inflation. But if they raise them too high, they will trigger a deep recession and a wave of bankruptcies. We saw a preview of this in March 2023 with the collapse of Silicon Valley Bank. SVB failed because the Fed's rapid interest rate hikes crushed the value of the long-term government bonds it held. It was a direct consequence of policy. A similar, larger-scale mistake, either by raising rates too far or cutting them too soon and letting inflation run wild, could easily be the trigger that destabilizes the entire system. The second horseman is a geopolitical shock. Our interconnected world is increasingly fragile. A major conflict, for example, in the Middle East that chokes off oil supplies, or an escalation of tensions in the South China Sea that disrupts global trade, could be the black swan event. Such an event would cause energy prices to spike, supply chains to break, and global markets to panic. In a world already groaning under the weight of debt, a shock of this magnitude would be more than enough to tip us over the edge. Confidence is the glue that holds our financial system together, and a major geopolitical event would shatter that confidence in an instant. The third horseman is a major corporate or financial institution failure. Think of Lehman Brothers in 2008, but on a larger scale. It could be a major bank, particularly in Europe or Japan, where the banking system is arguably weaker. It could be a massive investment fund that made a bad, leveraged bet. Or it could be a too-big-to-fail corporation in a critical sector that goes bankrupt, sending shockwaves through its suppliers and creditors. The interconnectedness of our financial system means that one big failure can cause a contagion. A domino effect, where one institution's collapse triggers another, and another, until the whole system freezes up. The fourth, and most likely horseman, is simply a deep, prolonged recession. Sometimes the trigger isn't a single dramatic event, but a slow, grinding halt to economic activity. As unemployment rises, people stop spending. As people stop spending, corporate revenues fall. As revenues fall, companies lay off more people, and they begin to default on their debts. The zombie companies would be the first to go, followed by over-leveraged households. This creates a vicious cycle that feeds on itself. A recession would expose all the weaknesses and excesses that have been built up during the years of easy money. Any one of these horsemen could be the final straw. And the terrifying part is, they are not mutually exclusive. A geopolitical shock could easily lead to a policy mistake, which then triggers a recession. The system is so fragile, so complex, that the point of failure is impossible to predict with certainty, but the existence of the risk is undeniable. If you are still with me, it shows you are serious about your financial future. Please hit that like button and subscribe so you don't miss our future updates on this critical topic. Building your financial arc, an actionable 5-step plan. All right, we've spent a lot of time diagnosing the problem. It's a scary picture, and it's easy to feel hopeless. But remember, this channel is called Hope to Wealth. Knowledge is not meant to create fear. It's meant to empower you to take action. You can't control what the Federal Reserve does, but you can control your own personal economy. It's time to build your financial arc to ride out the coming storm. Here is a 5-step plan. Step 1. Eliminate high-interest debt. This is non-negotiable. In a world of rising interest rates and economic uncertainty, high-interest debt like credit cards is a cancer on your finances. It's a guaranteed negative return. You must become laser-focused on paying it off. Use the debt snowball, paying off smallest balances first for psychological wins. Or the debt avalanche, paying off highest interest rates first to save the most money method. Cut up the cards if you have to. Sell things you don't need. Take on a side hustle. Getting to zero on your consumer debt is your #1 priority. It is the first and most important plank in your arc. Step 2. Build a robust emergency fund. Your goal should be 6 to 12 months of essential living expenses. I know that sounds daunting, but start small. $1,000. Then 1 month's expenses. Keep this money liquid and safe in a high-yield savings account. It is not an investment. It is insurance. This fund is what will allow you to survive a job loss without having to go into debt or sell your investments at the worst possible time. It is the foundation of your financial security. Step 3. Shift your asset allocation. In the coming environment, paper assets tied to debt, like many stocks and bonds, are at risk. You need to focus on real, tangible value. This doesn't mean sell all your stocks. It means re-evaluating. Consider overweighting your portfolio towards sectors that are essential, like consumer staples, energy, and healthcare. More importantly, consider adding a meaningful allocation to hard assets. This means physical gold and silver, which have been a store of value for thousands of years and tend to perform well during times of currency debasement. It could also mean productive real estate, if purchased wisely, without excessive leverage, or even commodities. Diversification is key. Don't have all your eggs in the Wall Street basket. Step 4. Develop multiple income streams. In the 21st century, relying on a single job for 100% of your income is one of the riskiest financial strategies you can have. You need to build redundancy. This could be starting a small side business, developing a freelance skill, creating a digital product, or investing in dividend-paying stocks. The goal is to create a situation where if one income stream is cut off, you have others to fall back on. This is about moving from a position of fragility to a position of anti-fragility. Step 5. Invest in yourself. The single greatest asset you have is your own ability to earn, adapt, and learn. In a rapidly changing world, your skills are your true security. Learn a new trade. Get a certification. Learn about investing, economics, and how money really works. The more you know, the less you will fear, and the better you will be able to spot opportunities that always arise during times of crisis. Fortunes are not just lost during these transitions, they are also made. By following these 5 steps, you are not just playing defense. You are building a resilient, robust financial life that can withstand the storm and thrive in the aftermath. It takes discipline and sacrifice, but the peace of mind it brings is priceless. We've covered a tremendous amount of ground today. We've dissected the three-headed monster of government, corporate, and household debt. We've seen how the flawed solutions to the 2008 crisis sowed the seeds for an even bigger one today. We've looked at the potential triggers that could detonate this bomb, from a policy error to a global shock. It's a sobering reality, but ignoring it is not a strategy. The era of easy money and pretending that debt doesn't matter is over. A great reckoning is coming. But, as we've laid out in the final part, you are not helpless. You have the power to take action. By eliminating your personal debt, building a cash buffer, owning real assets, creating multiple income streams, and investing in your own skills, you can opt out of the fragility of the mainstream system. You can build your own personal economy based on sound principles. This is the path from hope to true wealth. It isn't about getting rich quick. It's about becoming financially indestructible. If this video has opened your eyes and provided you with value, please help us spread this crucial message. Hit that like button, subscribe to Hope to Wealth for more honest conversations about money, and share this video with at least one person you care about. And now, I want to hear from you. What is the one step you are going to take this week to start building your financial ark? Let me know in the comments below. Thank you for watching, and stay vigilant.